Okay, so I'm gonna make a start here in a second. Just prepping what we're gonna talk about here in today's economics webinar. So I know that obviously I've put this live on YouTube, but that doesn't really matter. I've just done that so people can join if they want to ask questions. But either way, this was just an easy way for me to do it, and it will just get uploaded straight to YouTube. And obviously it gives people the opportunity, if they want to drop in, to have a listen live and maybe potentially ask questions which others might not look at. So we're going to make a start in a second. Just want to check signals all okay. Yeah. Alright, cool. Let's make a start in a sec. Right. Okay, we're gonna make a start. So, hello everyone. Welcome to a economics HTG webinar. So, we're obviously today, what we're going to be focusing on is interest rates and the forex market. So, why interest rates obviously a major thing when it comes to forex is because fundamentally, interest rate decisions are a massive a massive influence, let's say, on the movement of prices, right? In terms of whether there is more investor confidence or in the reverse, right? So interest rates are a massive thing. Obviously, for those of you who watch the live streams, for those of you who obviously follow the my trading, we talk about interest rates on a fair bit, but obviously we know that when it comes to interest rates, that has a major effect on the price, right, of currency pairs. Obviously, we're going to dive into the reasons why that is. But first of all, obviously, we're going to talk about what interest rates are, maybe for those people who don't know, and how that kind of interlinks into forex and just some other information that we can gather. So, the first thing that we're going to obviously talk about when it comes to interest rates is who actually creates the interest rates, and what are they. So the first thing, obviously, we talk about what are the interest rates. Well, the interest rate is basically what we call in economics the base rate, right? And the base rate just simply means it's kind of like, if you think about it simply, it's just like the lowest rate at which you can borrow money, right? Or in terms of an investment. So let's say, for example, you were going to get a mortgage and the current central bank base rate was 0.5%, you technically could not be charged. You can't get a loan or a mortgage, let's say, for lower than that. That is the base, that is the standard rate. So that obviously does affect your mortgage rate and stuff like that, but we're going to talk about that later on, and talk about maybe how that's not quite the case, but it is in what typically seems to happen when interest rates obviously changed, and we're gonna get onto that. But you can just simply think of it simply as kind of the lowest rate. That's just how I personally would put it, but obviously it is what is called the base rate, and that obviously what we could say there is set by the central bank. Set by the central bank. Who are the central bank? Well, that would be your BOE. Who is your BOE? That is your Bank of England. So for GBP JPY, that's obviously going to be a major central bank player on that currency pair. Who else would be? Well, that would be the BOJ. Who is the BOJ? That is the Bank of Japan. So effectively, when it comes to GBP JPY, these are the two central banks that are really going to make a difference when it comes to the exchange rate, right, between the pound and the Japanese yen. So that's obviously who actually sets the rate, and that is your central bank, the central bank of whatever currency it is. So the Bank of England would be your pound. Your Bank of Japan would obviously therefore be your Japan the central bank for the Japanese yen or Japan. So yeah, so that's who sets the actual interest rate, okay, which is the central bank, and like I say, they set what is known as the base rate, okay. And getting more into what actually is the base rate, what is the interest rate, right? In definition, it is the cost of borrowing money, right? So what do we, is, to put it simply, what is borrowing money? Well, that is your loans, your interest on loans, mortgages, right? Even investments, you could argue, right? That is your interest on these loans, mortgages, investments, etc. So that's pretty important in terms of an economy, right? Because if you think about it, if interest rates, what we're obviously going to discuss is when interest rates are high, what's the effect when interest rates are low. But effectively, if you think about it in a way that, think about how an economy would potentially be doing if there's low interest, right? If there's low interest, that then suggests that the cost of borrowing is low. If the cost of borrowing is low, that maybe suggests that you can almost, in effect, take your foot off the gas, right? That the economy is doing well. You're trying to keep, or you could say, let's not say the economy doing well, but what you could say is that a low interest rate encourages like investment, encourages borrowing, right? So in effect, that's actually the opposite. What I meant to say, sorry, is that it's showing the economy is not doing well, right? If the interest rate is high, you could argue that it shows that the economy is doing well, because then effectively you're not having to encourage that borrowing aspect. But we'll go a little bit more into that. I just want to briefly go over. That's not set in stone, but that's just like a theory-based point, right? But we'll actually talk about that properly in a sec, which is kind of what I'm leading on to next, and that is, how does the interest rate change? Like, what effect does that have? And then we're obviously going to tie that into the forex market. So if we look at, let's say, for example, higher interest rate. So if the interest rate let's say there's relatively high. Let's just start off with relatively high interest rate. Well, what does that obviously mean? Like we said, it makes borrowing more expensive, right? So if we're trying to make borrowing more expensive, what does that mean? That basically means you're trying to disincentivize borrowing. And what is borrowing? It's a form of investment, really, if you think about it, because you have to, you're in effect, you're having to pay back money, right? And obviously a lot of investments are, debt related, or they're borrowed money, right? So like we said, borrowing more expensive, that's trying to disincentivize, let's just say, investments. Okay, so usually when an economy is doing good, or let's say, let's not say good, let's say, to be a bit more precise, let's say that the economy is, overheated. Overheated is a good place, a good word to describe it. Like, yeah, let's just go with overheated. So it's disincentivized investments, and let's just say economy overheated, right? So we almost need to take our foot off the gas a little bit, right? So that's obviously a key point. Then what does it mean then on the flip side? And then what you could also say is that it appeals to savers. If interest rates are high, remember, you get, even though it's small, you get interest on savings, right? So that appeals to savers, which means that if you think about it in economics terms, if more people saving, that equals less spending in the economy overall. So you have to see how these things intertwine. Oh no, we want equals, not plus. So that equals less spending in the economy. And what is less spending in the economy? This is getting a bit, we got equals, that is your retail sales, right? So now you're just going to start to see how these things all, level up, right? So let's also go that one like that. Yeah, perfect. Okay. Then we can go like that. Wicked. So higher interest, borrowing more expensive, disincentivizes investments. Economy would be then overheated, let's say, and it appeals to savers. If it appeals to savers, more people saving, less spending in the economy, that's going to affect your retail sales. So what then is that on the flip side, right? On the flip side, you've got lower interest rate. That's going to increase. Lower interest rate is obviously going to make borrowing cheaper. First of all, sorry. If borrowing is cheaper, what does that mean? Well, that means that we're trying to encourage, let's say investments, right? Whether that be people investing into assets through mortgages, etc. Because even when you're going for a mortgage, you're still investing, so to speak, into an asset. You're still putting your money to paying off an asset. But obviously that's another discussion for another webinar. But yeah, so like what we said, borrowing cheaper, encourages investments. We could argue then that this is due to the economy maybe struggling. We could say potentially during recession. Well, obviously, we're going to link that into the current, in fact, we're not going to use the word current. We're going to say with the pandemic that happened previously. We're going to say about that, how that obviously affected, and why then, as a real life example, we saw interest rates obviously got cut. But let's say then, encourages investments, and during recession time, potentially, this is when you would typically see lower interest, and obviously that appeals to borrowers. Okay, because now their loans, their mortgages, etc. are now cheaper, right? And so if it appeals to borrowers, that means it we could say disappeal, or doesn't work in favor of savers, right? So not good for savers. Now your current account, now your savings account, you're getting a lot less interest annually on that savings account, right? So are you now realistically going to save all your money? No. What are you going to do? You're going to either go and invest it, or you're going to go and spend it. So if you're not wanting to save, because there's no point, because you're not getting good interest on it, now you're going to increase spending overall in the economy, right? And that obviously again leads to retail sales. And what else does it lead to? Big one here. Inflation. key aspect. Why? Increased spending, right? Low interest rates. You could, all these things link in, and how inflation can come into play. Okay, but that's obviously something else we're going to talk about. But we can just touch on the fact that when it comes to inflation, right, the way to tackle inflation is to obviously increase that interest rate, right? Why? Because then you start to make cost of borrowing more expensive. But we'll actually come on to that point when we actually talk about inflation in its own webinar. But we can just touch on it with that current statement that I just said there. So how does this tie in to the forex market, right? Well, when it comes to forex, okay, so let's just go back. Forex, right? How does this tie into forex? Well, of course, like what I kind of mentioned, interest rates are a overall economic health indicator, right? So how that affects obviously the forex markets is if you have an economy where things are not going very well, interest rates have to be cut. That's going to have a very damaging effect on its currency, right? Because that shows in terms of economic health that things are not going well in that economy. So naturally, money is going to be pulled and taken out of those economies, right? Because the economy is potentially going into that recession time. On the flip side, when it comes to when economy's doing let's say well, and interest rates get raised, that's obviously going to have an effect, right? Because as you see an economy doing well and interest rates are high, let's say for example, then what that's trying to say at that point, or let's not say interest rates are high, but let's say interest rates are stable. There's not been any need to cut interest rates, right? Let's put it in that perspective. There's no need to cut interest rates. That's more of a positive economic health indicator for an economy, right? Because we're not needing to cut rates. Rates can stay the same. Everything's fine. No need to panic. We don't need to do anything. That obviously, of course, is a positive. But when you actually have that rate cut, so if we talk about, if we go to the next point, rate cuts, right? What does that do? Well, that shows that economically things are not going well, right? And that's going to impact the forex markets. It's going to impact your exchange rate. Okay, so obviously when we're going to talk about the example, which we can actually go and see, if we go to, let's just say, our monthly chart, and we just kind of ignore this writing, but we move over here. If we actually go back to when there was the pandemic, right, when the obviously COVID came along, what we can see is that we had this big drop over here on the exchange, on the exchange of GBP JPY, right? So this candle right here, we have the brush. So this candle right here on your monthly was when we had lockdowns come in, and we had the pandemic, and mainly what kind of happened during this period was the rate cut, right? So your rate cut. So how did that affect the price? Well, it pushed price down. Why is that? Well, having to cut rates shows that the lockdowns, on top of, let's say, the lockdowns as well, meant that it was an overall bad economic health indicator, right? Or let's say that it was a bad sign for the economy, because that meant that they needed to stimulate investment. They needed to make cost of borrowing much cheaper to try and get the economy, to try and stay stable. Giving out, let's say, for example, coming off that, your typical business loan, right? Now you start encouraging businesses to take loans at much cheaper rates, right? Now more businesses are going to take those loans to survive, right? Business loans. And then we'll come off there cheaper, right? We know business loans would then be cheaper. So you're trying to effectively show your hand as a central bank to say, okay, we need to try and stimulate the economy. We need to try and keep businesses going. So effectively, that's why you saw investor confidence in the pound, right? Which is, when we talk about GBP, it's a risk currency. Risk currency. So therefore, it's way more subject to interest rate decision volatility, right? Because it's a risk currency. So investors pulling their money out of the currency at this point, based on the idea what we talked about, showing the economic health indicator by cutting rates, basically. And it works in the reverse, right? It works in the reverse. We had that. Now we had in 2021, end of 2021, or let's say from the middle, we've had potential for interest rate hikes, right? Why? Well, potential recovery has been made from the lockdown, from the pandemic, right? Now we have inflation rising in the UK at the moment, if you look at that. Okay, so what does that mean? Well, that means if inflation is rising, that means that there's potential for the central bank to need to act to increase the interest rate. If they increase the interest rate, obviously that's going to show as well, like we were talking earlier, that the central bank are ready to start pushing the economy into that next phase, that potentially we're out of that poor and bad economic period, which is why you had this candle on the monthly, which you should all remember if you trade GBP JPY, which pushed up price based on interest rate hikes. So you can see, if we see interest rate cut, you can typically see a downside move on pound yen, right? So JPY safe haven strengthens, but when there's interest rate hikes based on GBP, then let's say that you get an outflow of safe havens and into your more risky currency assets, being your GBP, right? Which is why we saw that upside move. But yeah, so I think, in relation to how we actually see it, there's two pretty good examples. So you saw, just to reiterate, when we had interest rate cuts, you see investors pulling their money out of your risky currency, which is your GBP, and putting money into your safe haven flows, which is where you see these big extensive downside moves. Same when there's interest rate. This wasn't even an interest rate hike. This was just a potential and talk for an interest rate hike. You can see how much there is that investor confidence and willingness to buy more of the risky asset GBP, right? So you can see that from the actual technical candle right there. Okay, so that's obviously something that's pretty important. So when it comes to forex, this matters to us because obviously we want to be keeping up with when it comes to, even if we just go to the weekly, you can actually see where that move happened from based off of the interest rate hikes. You can see how we had this extensive move up. Now you can understand how interest rates do play that fundamental part. So if we break down what's even happened recently on pound yen, which I thought would be a really good opportunity to see it in practice, what this means. So if we say that, okay, from this point here, this price point right here, to this price point right here was our, if we now do an arrow, this is your from a potential interest rate hike, right? Not even the actual decision, but just the potential for an interest rate hike. You can see that. Okay, we put interest rate interest rate hike. Awful writing, but oh well, you get the gist. Interest rate hike, we had upside. Then what did we have? Well, we had point where we had decision, MPC decision. What is the MPC? That is your Monetary Policy Committee. They are part of the Bank of England that make the decision for the interest rate. MPC, no change in rate. So there was not the potential in the end because they decided not to change. That meant correction phase. So therefore, there was an obvious reliance from investors to see interest rate decision changed, to become a higher interest rate, meant that there were more willingness to buy at that point, right? And then you can create that bias of, okay, if we then have a situation where the central bank is not going to change the interest rate, we know that can potentially create a downside movement based off the fact that since they said they was not going to change it, we've now seen let's say about a 50% correctional phase. Now, based off your idea of the technicals, whatever, you could argue, okay, if it happens in the future, we may now start to push back up to those high points, right? Yes, you're right. This is now a potential area, since at that point this was getting priced in of the potential interest rate hike. Now, because it didn't happen, we had a downside extensive move where we retraced some of that whole move up. But if it actually does end up happening now, because inflation obviously has increased, then we might see that continuation to the upside. So you have to keep that now back in the back of your mind, based off what the chart is telling you and based off what you know is happening as well. Okay, so this is some really key concepts, and you might think interest rates isn't, you don't need to know the ins and outs, but it's a pretty important thing when you want to learn how to trade, right? Because this is definitely going to affect any currency pair that you trade. Whether you look at gold, for example, right? We know that even with, let's say, gold, we know that the USD interest rate is going to be massively important when it comes to the outlook on gold, right? Again, it comes down to show the it comes down to investor confidence, right? And what the interest rate shows based on the current strength of that particular currency, and with gold, that being the USD. Okay, so if the Feds decide to cut interest rates, right? Let's say the Feds decide to cut rates. What's that going to say for USD? Well, that's going to show weakness. What does that suggest? Gold upside. If we see interest rates increase, what does that present? USD strength. What are we more likely to see? Gold downside. So again, the same kind of thing happened with gold when it came to the pandemic, right? Where was that? Yeah, so you can see here pandemic levels. Okay, you can see the drop that happened, but then that extensive move, again, weak USD, interest rate cuts, right? Gold went bullish. Okay, interest rate got cut. Now, why did gold go up? Because USD is weak, and now your gold safe haven now becomes your flow. Same with pound yen. When we saw that downside move, that's because now investors are pulling money into your safe haven assets like the JPY during a time of crisis. Okay, so that's why we saw that potentially. Well, not potentially, that is why we saw that, right? Because again, pandemic comes along, creates fear, creates uncertainty with investors, safe haven flows, plus on top of interest rate cuts, USD now becomes weak, move up on gold. Like we spoke about with pound yen, we had interest rate cuts, we had bad economic recession for the pound, investor uncertainty. You see that downside into, or when we see a downside in GBP JPY, that really means upside in safe haven flows. So your JPY is strengthening, right, and your pound is weak. Okay, so that's obviously a really, really key factor, and something that you really want to pay attention to, because these sort of situations, whether it be a pandemic or whether it be even just a general recession, it does boil down to investor behavior, and they typically tend to be in that same manner, right? Because you can see how we reacted during the same time period with a completely different asset, right? And with the same investor habit in a different asset like GBP JPY, you can see how the same, uncertainty created safe haven strengths, right? Safe haven flows. When we don't have that, when we have more certainty, we see more risky assets, GBP upside, right? Taken out now of your safe haven flows, right? So all in all, I think we've touched on a good amount of stuff here today. But yeah, so I want you to, obviously, you guys to take that information away. I think it's going to be obviously really, really valuable. And obviously it's going to tie in with a lot of other subjects when it comes to economics, whether it be inflation that obviously ties with interest rates, whether it be unemployment, all these other things. They're all interlinked, but they're something that you need to understand individually, and then you can piece it all together. But when it comes to forex, I think interest rates is definitely one of the most important things that you want to understand, or at least have a basic knowledge around, and then go and especially more importantly, understand how it affects the forex markets. If you don't do that, then I think you're putting yourself at disadvantage, because typically you see the like what we spoke about. Would you be looking for sells if you had I don't know, let's just say this was based off of an interest rate cut, and by the Fed, and then you had this upside move, which would be likely, as you've seen it before, right? So you wouldn't be effectively looking for sells, because based off of structure, based off the technicals, based off now the fundamentals, based off the principles of economics, that what moves you should be looking for. Okay, so you can actually use that to benefit your trading. But I think it's a really interesting topic. I'm glad that I went over it today. So yeah, so I just want to say, obviously, thank you everybody to watching. I'll let you know when we do the next webinar. It probably will be live again. It doesn't matter if not many people turn up. That's not really what I'm worried about. I just thought it'd be a lot easier to do it straight from the live stream. And then we can just upload it straight away, rather than doing a pre-record and whatnot. But yeah, so thanks everybody for watching. Drop a like, drop any comments, any questions you have, drop them in the comments section. Make sure you subscribe to the YouTube. Obviously catch me for the London session live streams as well, live forex trading Monday to Friday, 6:30 GMT, 6:30 AM GMT. But yeah, so stay tuned for more webinars. I hope that was really, really interesting. I hope you guys enjoyed that. Thanks very much for watching, and I'll